Today we'll be exploring accounting principles, in particular the revenue recognition principle. During June of 2016, Nathan mowed 10 lawns, all customers paying with credit. Jam said she would pay in a month. Ned said he would pay in 2 months. The other 8 also said the same thing. Nathan didn't receive any cash this month for his services. Does this mean his business is in debt and needs liquidating? Let's explain this concept. Before we get into it all and explain the concept of the underlying accounting principles, it is crucial to understand what accounting itself exactly is. Accounting is a systematic process of identifying, recording, interpreting, and communicating financial information. It reveals profit or loss for a given period and the value and nature of a firm's assets, liabilities, and owner's equity. Accounting principles. What are accounting principles? To ensure the effectiveness of this systematic accounting process, a number of principles and guidelines must be followed. These are known as accounting principles. Accounting principles are the broad underlying concepts and rules which guide both businesses and accountants when preparing financial statements and recording financial data. The specific accounting principle that we'll be exploring today is the revenue recognition principle. However, before we break down this concept, it is imperative to understand a few key definitions. Firstly, what is revenue? Revenue is the total amount of money received by a company or entity for goods sold or services provided during a certain period of time. Revenue is reported on the income statement for the period when the revenues are earned, not the period when the cash is received. This means that revenues can occur before the cash is received, after the cash is received, or the same time that the cash is received. Now that this has been said, what is the revenue recognition principle? The revenue recognition principle states that, under the accrue basis of accounting, you should only record revenue when an entity has substantially completed a revenue generation process. Thus, you record revenue when it has been earned. It's now time to put this concept into practice. A lawn mowing service completes the mowing of a company's front lawn for its standard fee of $100. It can recognize the revenue immediately upon completion of the mowing, even if it does not expect payment from the customer for several weeks in the future. Now, we've all said, let's summarize. Accounting principles are the broad underlying concepts and rules which guide both businesses and accountants when recording financial data. The revenue recognition principle states that a revenue should be recorded once a resource has been earned, and not just when the business receives cash. A business can recognize the revenue immediately upon completion of its services, even if it does not expect payment for several weeks in the future. Thank you for watching.